Good evening, everybody. Hi, welcome to our exclusive webinar on 5G and hot Chinese tech trends. All right. So do give us a few minutes as more people stream online. All right. Okay. If you have any questions, please put it into the Q&A section. All right. Okay. Today we have two special guests, of course. Adrian from CSOP Asset Management and also Benjamin Chan from CGS-CIMB. All right, I'll formally introduce them later. Just give us a few minutes, All right. Hope everybody had their dinner. And thank you for, taking your time to attend this webinar. Okay. Another 2 minutes before we start. Okay, another 1 minute. Are you guys excited? Oops. Okay. All right. Okay, let's start. All right. Right now it's 8:03. Welcome everybody to our exclusive webinar in partnership with CSOP Asset Management and CGS-CIMB. Of course, today's topic is about hot tech trends riding on the next big wave of Chinese tech companies. All right. So today we have two special guests, Benjamin Chan and Adrian Chiu. All right. Let me introduce them. So Adrian is actually the Vice President of Sales and Product Strategy at CSOP Asset Management. Adrian, you want to say hi?
Hi, thank you. Thank you for joining us tonight.
All right. So another special guest that we have, Benjamin Chan, who is actually the technical and quantitative analyst at CGS-CIMB Research. All right. So Benjamin, you also write for the Trendspotter for the HK section, right?
That's right.
Yeah, awesome. All right. Okay, without further ado, let's move on, right? So a couple of disclaimers here, all right? The usual. Okay, I think you guys, been seeing these disclaimers everywhere, all right? Nothing new. Okay, let's start, right? So, this year, COVID has probably changed the entire world, okay? So when we talked about the stock market, it actually dipped in the lows in March, right? So, to a lot of people's surprise, there was a very big recovery, right? But it mainly occurred in the new economy, which is involving technology and biotechnology, all right? So I would like to invite Benjamin, who is a specialist in the Hong Kong market, to actually share with us what's been performing well in the Hong Kong market so far, what are the laggards, and where are we heading in terms of the outlook, at least for the first quarter of Hong Kong in 2021. All right, Benjamin?
Thanks, Ethan. And good evening, everyone, and welcome to this webinar today. The flow for today will be the Hong Kong market 2020 recap, followed by the Hong Kong market outlook on the first quarter of 2021. Then we'll go on to the performance laggards, and we'll finish up with where we are heading. Overall, the Hang Seng Composite Index, in short, the HSCI, was launched on the 3rd of October 2001. The market peaked in November 2007, the subprime crisis. The drawdown was a horrific 69%, driven by asset bubble. Following that, the market has been doing well with reasonably minor corrections to date. So it is fair to say the Hong Kong market generally has been in an uptrend and up 60% of the time, month on month. For example, 7 months out of 12 months on average. The HSCI is subdivided into 3 sub-indices, namely the large cap, turquoise line, mid cap, purple line, and small cap, blue line, which cover the top 80%, the next 15%, and the remaining 5% respectively of the total market capitalization of the HSCI. As we can see, the consistent outperformance of the mid caps over the 20-year period. Some examples of these constitutions in the mid cap are New China Life Insurance, Zhejiang Mining, Manhua Holdings, Hua Hong Semiconductor, and China Longyuan Power Group. Here are 12 sectors in Hong Kong and their performance over the past 5 years. By far, information technology, the white line, has been a consistent outperformer. This is followed by the more defensive sectors such as healthcare, the blue line, and consumer staples, the orange line. On the other spectrum, sectors such as conglomerates, yellow line, and telecommunications, the green line, consistently underperformed over the past 5 years. So as you can see, information technology is the main driving force of the Hong Kong market and is likely to remain so. We move now to the Hong Kong market 2020 recap. The HSCI year-to-date performance is the positive 8.32%. The best performers in the sectors these names generally come from are this consumer discretionary in the automobile and restaurant space, information technology, healthcare, materials, and consumer staples. For the worst performers, the sectors these names are generally from the consumer discretionary in the real estate space, here, this is the relative strength over the past 1 year for the HSCI over the SPX. Overall, the long-term trend is down since 2010. This relative strength chart uses the HSCI divided by the SPX, and you get a ratio. If you see a consistent uptrend, then the HSCI is stronger than the SPX. And conversely, a downtrend would show the SPX is stronger than the HSCI. Of 1.20. So there are rotational windows that we can take advantage of during this period. As you can see, the HSCI has been underperforming the SPX over the course of this year, but the relative strength is supported by the 1.10 region and seems to bounce off it. So we can expect the behavior and the short-term relative performance for the HSCI against the SPX to rise to the 1.20 region and even to 1.25. This doesn't mean that
Hi, Benjamin. We lost you a bit there.
Have you got me?
Yeah.
Yeah.
Could you probably repeat the last two sentences
Sure.
for the benefit of the audiences?
Sure.
Yeah, thanks.
As you can see, the HSCI has been underperforming the SPX over the course of this year, but the relative strength is supported by the 1.10 region and seems to bounce off it. We can expect the behavior and short-term relative performance for the HSCI against the SPX to rise to the 1.20 region and even the 1.25. This doesn't mean the US will be negative, rather an outperformance of either one from time to time. We'll move on to the Hong Kong market outlook for the first quarter of 2021. Over here, this is a 2-year daily chart of the HSCI. In the previous 12 months, the market has gone nowhere. Since the top in January this year, we saw a 28% decline, followed by a recovery. This decline marked the start of an intermediate trend channel, within which the subsequent rally has been sustainably trending since. It has recently broke out of the 2-year resistance level of 3,950 in early November. The RSI, which is the momentum indicator, has been bouncing off oversold regions, indicating strong momentum. The modified MACD, which is our trend indicator, has been trending positively and has been above the zero line since July. This has been the longest period it has been for the past 2 years. Based on this evidence, we see a shift in market strength and direction. The current price action is at the lower half segment in the intermediate trend channel from a technical viewpoint, meaning the risk is much lesser to take fresh positions from the low end of this intermediate trend channel. Now, the market breadth has 174 names in the positive momentum model and 152 names in the negative momentum model. And I'll be talking about this momentum model in the next slide. We'll move on to performance and laggards. Here, this is our CGS-CIMB proprietary quantitative model. It is meant to screen out names which have strong momentum and showcase sector leadership and rotation. This statistical model automatically calculates an overall momentum score, then sorts and ranks them into 4 quartiles. The positive momentum model screens for liquid stocks within the universe that displays strong momentum. The higher the score, the stronger the stock is. On this slide, this is our Hong Kong positive momentum model in the first quartile, which exhibits stocks with very strong momentum. Similarly, we have second, third, and fourth quartile for strong, fairly strong, and moderately strong momentum stocks, respectively. In contrast, there is also a negative momentum model. Here, I have picked a stock from the first quartile of the positive momentum model. Based on the technical evidence, we see that the major uptrend is intact and there is strong buying support at the 50-day EMA. Xiaomi is likely to trade higher towards our 3-month target price of 36 Hong Kong dollars and 45 cents. This projection is based on the major trend channel and Fibonacci extension lines. Furthermore, we observe a lot of customers, or consumers rather, buying Xiaomi products as they are willing to pay for it. These products include mobile phones, power banks, vacuum cleaners, weighing scales, and so on. Also, on a financial standpoint, the company has improved the performance and better financial results. Recent share placement was issued in September and early December. Look, this is Lenovo Group. I made a technical call for our technical research publication, Trendspotter, on the 10th of November at 5 Hong Kong dollars and 41 cents. And it played out according to plan. The momentum is getting strong, and we expect a pullback before the main trend to continue. Lenovo is currently at a 52-week high, and it has broken out of the trend channel. So it is not an optimal price entry, but you can wait for a pullback between $6 and $6.30. Based on this technical evidence, we see that the major downtrend is over, and the recent price action has been well supported by the 20-day EMA. Lenovo is likely to trade towards our 3-month price target of $8.70. This projection is based on the confluence of major resistance level. Therefore, usually price momentum is driven by fundamental changes in earnings and revenue, leading to a shift in impact of investors' confidence and sentiment, thus driving capital inflows and outflows. Where are we heading to? Over the past 1 year, information technology, on the white line, has been the outperformer, leading with 72%, with no surprise. This is followed by healthcare, the blue line, up by 36%, followed by consumer discretionary, the green line, up by 28%. The top performers in IT are Kingdee, BYD Electronic, followed by Xiaomi. The top performers in healthcare are Microport Scientific, Alibaba Health, followed by LifeTech Scientific. And the top performers in consumer discretionary are Yade Group, BYD Company, followed by Waymo. So since the beginning of this year, the momentum of information technology still persists 12 months later and continues to maintain leadership. The Hang Seng Tech Index has gained over 120% over the last 2 years, outperforming both the Hang Seng Index and the Nasdaq over the same period. The Nasdaq's performance is by virtue of the market structure, not because of government policies to drive that sector. The HSCI tech sector, however, is riding on the sector rotation in global tech, and is also the catalyst from the Chinese government. The market is currently driven by information technology, and especially the launch and adoption of 5G services. Consumers have been using technology more often, especially since the work from home period. For instance, we are playing more games, ordering food online, shopping online, etc. This is now the new norm, and consequently, our screen time has actually doubled. With this, I'll hand over to Ethan to elaborate more about the Hang Seng Tech Index.
All right. Thank you, Benjamin, for sharing. I think I would agree. A lot of our audiences will also agree with you that a lot of people will be sharing, their eyes and their, attention on screens, right? Right.
Yes.
So let's move on. Yeah.
Yeah, especially the stock numbers between the US and, like I mentioned, over 120%. So that's quite astonishing too.
Yeah. Thank you for sharing, Benjamin. So let's move on to the next question, right? So I think in this day and age, right now we're in a stage where Donald Trump has sort of lost the election, right? And we are still in the midst of a US-China trade war, right? So I think recently the trade war has also spurred the partial return of these US-listed Chinese companies back to Asia, and a lot of the companies are actually looking at the Hong Kong equity market, and Hong Kong equity market is actually actively embracing them as well. So in July, the Hang Seng Tech Index was also launched to meet the investors' demand for growth stocks like this, right? As a much needed complement to the financial and property heavy Hang Seng Index, and to actually reflect the growth in this sector. So I'd like to invite Adrian, who's an expert in this field, to actually shed more light on this. Adrian, what do you think?
Yes, Ethan, that's a very good question, and I think it's a good introduction and why we are here today. So just a bit of history on how do we get here today. I would say all thanks to Donald Trump as the president of USA, right? So it started off in 2018, Donald Trump elected as the president of USA. And then he started a trade war with China, imposing tariffs, trade barrier. In the end, it caused a lot of harm to both economies, being the first and the largest and the second largest economy in the world. That caused a major collision between two powerhouses. And having said that, the trade tension is actually boiled over into the tech sector. And you can see the US administration started to scrutinize into Chinese tech stock. For example, they start to target Huawei, then they start to target ByteDance and Tencent respectively, because they were running apps such as TikTok and WeChat respectively. So they were deeming these apps, they were being accusing these technologies companies are providing apps that's actually posing a threat to US national security. So having said that, with such scrutiny and the tightening of the clamps, they were under the spotlight. These Chinese technology companies started to think ahead. Let's hedge ourselves. The risk of the digital iron curtain falling on them, being forced to delist, is getting real. So they was like, oh no. So what they do is actually they start to look for alternatives. They start to look for maybe we could go back to Asia, go back to China. That's where most of the users of these apps are Chinese citizens or the Chinese or the Asians are using these apps, right? So why don't we consider do a dual listing back into China Exchange or the Hong Kong Exchange? And having said that, that's where being closer to the user, being closer to the population that are using their apps, and by then hence therefore I think with this crisis, starts the creation of the Hang Seng Tech Index and also the birth of our ETFs.
Thanks, Adrian, for sharing.
Yep.
All right. I think one of the things down here that actually caught my eye and probably caught a lot of the audience's eyes is actually the Hang Seng Tech Index.
Yes.
So, since you talk about the Hang Seng Tech Index and it was just listed in July, right? Could you probably share more about this as well?
Certainly. So would you go to the next slide, please? Yeah. So now, again, a bit of history, how would an investor, a normal investors like you and me, were to look for the next Tencent? How do we find the next Tencent amid a huge universe of the tech industry? And technology is actually ever innovating and it's a very niche industry. So how would a normal retail investors, just like you and me, find the right stock, the right next Tencent, and capture the growth opportunity of a certain company? To find the next Tencent is very rare. To find such a rare gemstone. Just a bit of a history again. In 2004, Tencent IPO price was only like $3.70 Hong Kong dollars. Just fast forward 16 years, a very short period of 16 years. Right now, if I believe the closing of the Tencent is actually at 580 Hong Kong dollars. So it's a tremendous increase in terms of share price. But there's a fine few stocks that can actually there's such a huge in the universe. How would we know that the tech stock that we buy is Tencent, right? So technology is ever evolving, and it's very hard for us to capture the right company is providing a right product that would disrupt in the future and provide growth in the exponential growth like Tencent in the future. So what we do is actually this Hang Seng index provider believe that they could actually come up with an index that actually provides but by targeting top 30 market cap, but 30 tech stocks in terms of market cap, and put it into an index and put it in for us, put it into an ETF that will actually help the investors to achieve one, diversification, yet to ensure that the tech company that's within the index and within our ETF is the fittest, and also providing the right product into the market. So just a bit of a sharing of the index is actually, like you say, it's actually induced. It was incepted this year in July in July this year. Right now, the market cap for the index is about 11 trillion Hong Kong dollars as of November. And they have certain criteria, certain methods on what kind of tech stocks can be included into the index and into our ETF. So it has to be number one, a Greater China company listed on Hong Kong Exchange on a main board. It needs to pass the velocity test. That is the liquidity test of the underlying constituents. The companies have to be very liquid. They have to focus on certain sectors like IT, consumer discretionary, industrials, financial, and healthcare. Certain themes of the sectors is that you have to be cloud, digital, e-commerce, fintech, and Internet of Things. Now, if you pass all these criteria, they also have very stringent criteria that the tech-enabled business has to, one, put in 5% or more of their revenue into research and development. This to ensure that the tech companies are actually constantly innovating new products. Then, and in terms of generating new disruptive methods into our life. Either that, or the products that they have already in the market are actually generate revenue 10% or more. This is to ensure that they are one of the fittest as well. And having said that, like I did mention, the constituents, they put in the top 30 largest market in terms of market cap into the index and into the ETF as well. You cap each stock to have a maximum weightage of 8%. This to ensure that the investors that buy into this ETF and in tracking this index would have a suitable range of adjustment of diversification. It's quarterly rebalanced. Now, the beauty of this index that's actually not ever seen in like, for example, STI index is that they have the fast IPO entry rule. So let's say a new tech stock is listed, it's very hot, it's very popular, but with this fast IPO entry rule, if on the first trading day, on the first IPO trading day, they close within the top 10 of market cap, on the 11th day, this new tech company stocks will be added into the index and automatically will be added into the ETF as well. So a classic example would be JD Health. JD Health would be included into the index and into the ETF next Monday on the 21st of December, because it closed on the first day, it closed within the top 10 in terms of market cap. And having said that, from now to March the 8th next year, number of constituents will have 31 stocks within the index and within the ETF. So I think that would actually be, the investors into the ETF will actually, be exposed to 31 stocks of, in terms of share price increase. So this is how the beauty of this ETF and this index as well. Yeah. Ethan, you're mute.
Sorry, thanks for telling me that. So thanks for sharing, Adrian. I think one of the things that actually caught my eye and a lot of retail investors' eyes is actually this fast track IPO thing that you actually talked about, right? So let's move on, right? So I also know that CSOP Asset Management also happens to be actually the first issuer to launch an ETF to actually track this index. So could you share more about this ETF? And when you guys actually launched it,
Sure. So we just shortly 1 month after the introduction of the index, we try our best and negotiate with the Hang Seng index provider and say that with a wide network of clientele that we have, they were asking us whether can we do an ETF to track the index. And we try our best and we work very hard. We work day and night, and within a month, we're able to secure, we're able to clear, all the legal and compliance and everything, and we're able to list the first ETF that tracks this index. And how do we replicate it? We do pure replication. That means the underlying of the assets that's actually making up this ETF is actually the actual stocks itself. We do not enter into derivatives. We do not go into swap agreements. It's full physical replication. And within our prospectus, we clearly states that only in special condition, then we will move to a representative sampling strategy. That means we will do something that's not full replication. When, for example, like due to restriction, due to suspension of certain stocks, limited availability of the underlying stocks, and we clearly specify that with this, either of these three conditions happened, then we will do sampling, right? Or else we will clearly state that it's full physical replication. And having said that, being a first mover, we have of course the able to acquire a large asset under management, and right now we have about or even more than $5 billion in terms of AUM. And if you look through our data, we do have actually more diversified investors. I mean, what I'm trying to say is that most of the investors are investing into our ETF. Not only we're the first, but we have actually a wide range of investors, and it's hence with less concentration on just a particular investor. I think that lowers the risk if touch wood and there's some kind of redemption going forward. So we will not be affected because of the type of investors that we have underlying. Yes. So and having said that, we also do have a lot of a robust market making in Hong Kong. We have actually 10 market makers market making our ETFs in Hong Kong Exchange. And having said that, with 10 market makers, we are actually quoting one of the tightest spreads ever. This is actually something that I will touch on later. That this is actually one of the hidden costs that actually most of the traded investors need to take note of. And ours is actually very tight spread. For Hong Kong Exchange, they removed the stamp duty. Usually back in 2015, before that, Hong Kong Exchange imposed a stamp duty of 0.1% stamp duty for a buy and a sell. So back then it was actually quite expensive to trade ETF on Hong Kong Exchange. In and out of a stamp duty, you have to pay about 20 basis points or 0.2% already. But they have ever since 2015, they actually waived off, and that actually helped more market making activities and more investors coming in and trade the ETF. Also that it's actually relevant trading hours. The ETF and the underlyings are actually trading in a similar trading hours, which means that the ETF starts trading at 9:30. The underlying stocks like Tencent, Xiaomi that Benjamin has mentioned also start trading, and when the ETF stop trading as well when the underlying stop trading. So there is constant liquidity and constant tracking very close to the net asset value of the ETF as the underlying stocks are also trading as well. Oh yes, yeah. So we'll probably have to talk about a little bit of education of the investors right now. That usually we just want to check the total expense ratio. In short, we call it TER. But you need to understand that also the bid and ask spread and the liquidity as well. So for example, what I'm trying to say here is actually like if it's a very wide spread. For example, 7 basis points. If you were to trade in and out, the round trade itself will cost you 14 basis points or 0.14. And if you trade, more than, let's say, for example, 3 times in a year, it's most likely you will do so because tech sector is more volatile. You actually get to, incur more than the total expense ratio that some of the asset managements or the ETF publish, right? So like I said, we continue to build an ecosystem within Hong Kong that will ensure that not only that we provide a tighter spread, very good liquidity to the investors, we also want to manage in terms of building a whole ecosystem in the sense that we will actually reach out to all our clients, then different type of clients such as banks, hedge funds, traders, discretionary portfolio mandates, people to actually invest into our ETF because of the tight spread. They do really use our ETF more frequently though. Yes.
All right, thanks Adrian for sharing that. So I think investors also need to know whatever you spoke in the previous slide as well, like the bid and ask spread and the liquidity of the ETFs, which it could affect the returns of retail investors, right? So let's move on to the next question, right? So last month, everybody was actually anticipating, Ant Group's IPO, right? So there was a lot of hype saying that it's going to be like one of the biggest IPOs in at least Asia. Right. So in the dramatic change of events, the plug got put, right?
Yep.
So I'd like to ask, how do you actually see this move by the authorities, right?
Yep.
And leading on to the next question, do we actually foresee new laws in China being enacted in the near term? Because I think just a couple of days ago, Tencent, Alibaba has been been under the authorities eyes, and they've been fined. So can you share with us on more on that?
Yep. So Trouble, you go to the next slide. Yes. So just to share a bit of what he did mention was pretty true. Like it's actually a good question. How do we think? What would we think? What would chairman? What would the Chinese government think? We will try to think ahead of what the Chinese government do. We observed that there was actually a net outflow of AUM, during the US pre-election, right? Even though the index was actually, going up about more than 10%, we see, a sign of profit taking back then. We were like puzzled because the index is going up and there's outflow of 230 million from our ETFs, and just nice, you did mention the Ant group was put a plug, right? And then having said that, on the 10th of November, Chinese government decided to introduce a draft of the new anti-monopoly policies, right? It's still in draft mode, and that caused a reversal of trades, a drop of 10% for the index and for ETF as well. And also, we also know that Trump has lost. Biden is the president-elect for next year. We were quite surprised that the index fell. I think because it's due to the two factors, right? Biden and also with the anti-monopoly policy, the index fell more than 10%, given up all the gains that they have. Surprisingly, we see a trend of buying into dips. We see an inflow ever since of more than doubled of the outflow. So the outflow was back then was 230 million Hong Kong dollars. We saw an inflow more than doubled of Hong Kong $480 billion coming back into the ETF and coming back into the sector. So we believe that even though Biden is actually will be the next president of USA, I think he will be strict in terms of the policies and his stance towards China, but I think it will be more predictable. And having said that, we strongly believe that Chinese government still needs to rely on the Chinese tech companies to want to outmaneuver the US tech companies, to challenge them, and to provide also one is actually about their 14 5-year plan that they say that they want to groom and support homegrown technology companies, plus using those technology companies to boost domestic consumption. They call it dual circulation theory. They call it during the 14 5-year plan. So we believe that with that, with the government support, I think with that policies, we still believe that the fundamentals of the technology sector is still intact. We just believe that these whipsaws are just a reflection of noise and emotions within the market players. In general, we are still optimistic with the fundamentals of the technology sector. So back to the second question, would there be new laws? I believe the answer is yes. I think it's just that once the tech companies are back into China realize that with the growing influence of these technology companies, they need to strike a balance between growth and also managing the risk within their system, the financial system, for example. And that I think we think there's more laws coming in. We're trying to strike a balance between growth and risk. And I think we also expect more volatility going ahead for this sector as well. Yeah.
Thanks, Adrian, for sharing. I think you brought up a very good point where the authorities would actually be looking towards the direction between, balancing, growth and also the risk, right? So, talking about risk, so we'd like to ask on behalf of all the audience right here, right? So are there actually any hedging tools that investors and traders could actually use to hedge against such, let's say a black swan event, let's say, a complete ban, or even something that happens to, you know, TikTok or Tencent, you know, and possibly even generate a return from it, right? Is there any way?
Yep. Yes, we did. So before we dive into the tools, we need to understand what the tools will be using on. Probably want to share the behavior of the Chinese tech sector. Just to write on Benjamin's presentation previously, yes, tech stocks always, you know, generate much better returns versus the normal traditional index, because we believe that Hang Seng Tech is actually is tracking stocks that's on a growth category. Well, the Hang Seng or the S&P, we will categorize them as the old economy. So having said that, we did a 5-year back testing since 2015 to this year, right? And the Hang Seng Tech itself generates a return of 189%, right? That's very high return, versus Hang Seng itself only generate about 30% return. Having said that, you know, investors also would be exposed to higher volatility. We're looking at volatility for the tech versus the Hang Seng, is that volatility is about 30% for Hang Seng Tech, 20% for Hang Seng itself. So again, back to the nature of the category, Hang Seng Tech is considered as a growth sector, and Hang Seng is actually more value stocks and of the old economy. So higher returns, investors are exposed to higher volatility. And then we will also compare Hang Seng Tech and see where is the sensitivity, how sensitive is Hang Seng Tech to the rest of the indices. And we also realize that Hang Seng Tech is very closely correlated to A shares, which is the CSI 300, and also to US stocks. So you can see the behavior. It's definitely a very high growth stock, very high growth sector, but also very volatile as well. So I'll trouble you to the next slide, Ethan. So then we will compare, like, you know, year-to-date returns. Hang Seng Tech generate a year-to-date return of 32%, while Hang Seng itself, ever since, you know, we suffer from the COVID, is still not back to even break even. It's still down about 1.8% if you were to buy Hang Seng at the beginning of the year. But the volatility also have increased as well. And then we compare to NASDAQ, you know, both tech-to-tech indices. Surprisingly, we realized that Hang Seng Tech with a maximum drawdown of about 48% versus the NASDAQ, who's only down about 30%. So you could see that Hang Seng Tech itself is actually very volatile, and clients also could see will be exposed to actually a huge drawdown of about 50% just to expose themselves to higher returns versus the old economy. So what we can do is actually we can do a portfolio hedging, right? You know, like Ethan, you have mentioned, like, you know, there's black swan, new regulation by the Chinese government, COVID, pandemic, elections and things like that. So all these are actually black swan events. So we decided to, like, hey, you know, we could actually do a back test, and then we realized that why don't we do a hedging tool? You could actually do a inverse tool, which means that if the market were to fall, the inverse product would actually be up. So you're actually betting and hedging yourself for a market retracement. So, you know, rather than you just, you know, selling high quality stocks and then you buy, hoping to buy back to the dips, you can just continue to hold on to the stocks, and then you just buy an inverse product that to hedge yourself against any retracement or downtrend in terms of price. So we did the back testing, like, you know, for example, if you were to hold on to Alibaba, which is actually listed on the Nasdaq exchange as an ADR, and, you know, you could just invest into our inverse 2 times. It means that if the index were to go down 1 point, this ETF will actually be up 2 points. So what we do is actually we come out. We did our quant team, which is actually very qualified to do a back testing of how do we generate a trigger signal that we tell the investors to do so, or the traders to do so. So is that we do a 10-day trading day rolling volatility ratio, and if that were to hit 40%, that's where the signal for you to enter the inverse 2 times exchange traded product. When you exit, that's when the volatility ratios goes back down below 40. That's where you actually could take a profit on the exchange traded product. So we did back testing, and then with like holding on to Alibaba and using this strategy, the back testing result shows a alpha return or additional return of 30%. I would like to take this opportunity to say that past performance does not guarantee future performance as well. This is just one of the back testing that we did that found it's actually quite useful. Yeah.
Hi, Adrian.
Yes.
Yeah, we're on the next slide.
Okay.
You want to share with us a little bit on the Shinex composite?
Yes. So so besides what you did mention that earlier in the slides, let's say about the 14 5-year plan of China, and I think with the COVID-19 going on, we believe that healthcare expenditure will be one of the area that China will be looking at, and with the Hang Seng Tech, we call it the Oriental Nasdaq, 东方之珠 Nasdaq, right? We call Chinex as the China Nasdaq. So it's something that we coined out, and we try to differentiate between two products. And Chinex is actually more focused on to China's startups and growth stocks as well. So this is very similar to Hang Seng Tech, but it's a bit different in terms of the sectors that actually the Chinex is actually tracking. It's tracking more onto healthcare, information, IT, and industrial. So these 3 sectors alone take up about 76%. And we believe that investors should take a look at this because, like I say, China is actually spending more and has a capacity to spend more on healthcare versus developed countries. And I think with the COVID-19, I think that caused the Chinese government to sit up and realize that they should actually beef up their spending and improve the healthcare sectors. So I think this is a good index to actually take a look at it. Also, I think with the U.S. trade tension right now, right? Chinese governments wants to be independent, want to decouple from China, from the foreign economy and be domestically independent. So there are actually many plans within China that they want to build up their infrastructure. And having said that, 30% or more of the constituents within this index are actually related to new infrastructure. And the next thing is that why we believe that Chinex deserve a space in our portfolio is because that comparing to other major indices like the SSE and the CSI 300, Chinex is still having positive PE growth versus the rest of the 2 other indices. And having said that, I think that is where we find that Chinex being a growth, also a Chinese A shares growth sector, that with the positive PE growth, that's actually we found that there's actually more room for the price to grow to increase, and I believe that this is also one of the sectors within China that's actually pretty popular. No, so I would like to go to the next slide to see what's within Chinex. So some of the big firms that actually got popular during this pandemic is actually Meituan Biomedical. So what this company do is that they manufacture ventilators, which is actually very essential during the pandemic. Hospital needs these ventilators for serious COVID-19 patients to help them to breathe. So there was a surge in demand for ventilators, and that you could see on the chart within March, you could see that it's actually gone up more than 50% to a share price. And surprisingly, the chairman is Li Xingting. It's actually a Singaporean, and it's actually a second richest in Singapore according to Forbes. So yeah, this is something that most of the investors like us would not know about it, right? And then next one is actually East Money Information. So it's like a broker slash Chinese Bloomberg that provides financial information. And you could see that, no one would know unless you are Chinese that living in China that each day about 30 million viewers goes to their platform to look at financial information. Nobody knows that. And you could see that, I think in 2015, they reported a 2,000% increase in their revenues because of that. And, if you're not a Chinese living in China, you wouldn't know that East Money is something that you should look for. So having said that, what I'm trying to say is that most of the institutional investors and retail investors knows that, yes, particular sector is actually growing up. We should look at A shares. We could look at some of the ETF. We should look at some of the sectors. The problem is that we are not there on the ground. We wouldn't, as foreign investors, we were not able to locate such gemstones. And it's not only for retail investors, even institutional investors will not understand. So we do have an ETF, and the one and only that trades the China index as well. So it provides retail investors like us diversification and easy access into the China and the growing stocks listed on China in China. Yes. Yep.
Interesting sharing, Adrian. I didn't know that the chairman is actually a Singaporean.
Yes.
And I certainly didn't heard of the company's business before, because you are right. As retail investors, we don't have like a physical foothold there, right?
Mm-hmm. Mm-hmm.
So the next question I've got for you, right, is what are the upcoming trends in China, right? Could you share a little bit more on some insights or some forecasts of what are the upcoming trends? I'd like to hear your opinions on that.
Yeah. So again, what we do is actually we try to locate what the big trends or big direction that the Chinese government want to do, and what they reacting to external forces like what US is doing to them, and things like that. So I think right now the simple summary is that they are looking to be independent. With the saga with Huawei and 5G being sensitive, they want to build their own 5G infrastructure within China itself. And having said that, so that's their national strategy. They want to build the infrastructure. They want to be building up the 5G infrastructure within China. They were actually pretty late in terms of 3G, 4G stage, but I think they now want to be a leading adopter for 5G, and they're looking to generate, to have more coverage within China. And having said that, the China Academy of Information Communication and Technology, it's a mouthful, actually just released a white paper today that with this 5G infrastructure in place, they believe that the economic output will be 800 billion RMB going forward. Okay, and they will feel the impact of this within 2 to 3 years, as Chinese government are actually going to put a wider range in terms of coverage for 5G network. And having said that, can I trouble the next slide? We could see that 5G is already in China compared to the rest of the world. Surprisingly, just a few weeks ago, KFC has used 5G for their chicken trucks. So it's driverless. It's just a automated truck that goes around along the streets, and just Chinese will look at it and wow, that will actually provide will incur some kind of cravings when I mean, I'm sure when you look at a KFC truck, you definitely wants to eat it, right? You definitely want a piece of it. And they're using this 5G automated trucks to just going around, and I believe that boosts sales. You could see that people just use the phone and they just pay, and then just grab a packet of KFC chicken and have it on the streets. And we believe that it will be using for AR VR, so that means they will use virtual reality and impose onto augmented reality. That means you could look at a certain place, you look at a street, and they will tell you what shop to buy and some of the ratings that they have. So it's actually using virtual reality on top of the world that we live in. So having said that, right, yeah, we believe that 5G would actually open up a lot of possibility. It's a very, very niche market, and I think this is the next frontier. We will probably use it for AI learning. Wow, I mean, it's beyond my imagination. Yeah. So maybe Benjamin, you got something to add? What do you think of AI or 5G? How would it help you?
Yeah, I mean, based on the course of this year, other than your KFC truck you've talked about with food services,
yep.
It can lead on to even like things like online educational services we've used more frequently, digital entertainment consumption such as Netflix, online gaming even have all become part of our day-to-day life for more people. And this is not going to change anytime soon. Even traditional sectors such as healthcare or insurance, we are witnessing more and more people turning to technology to buying these online. For example, I mentioned Netflix earlier. Baidu obviously is a main competitor in China, and very popular. Tencent Music Entertainment is the direct competitor of Spotify, for example. So this, I guess, pandemic work from home lifestyle is not a driver, but rather a catalyst to adopt and embrace digital consumption at a much faster rate. So this 5G will actually assist to offer this faster consumption of technology, I believe.
Yep.
All right, thanks for sharing, Benjamin and Adrian. I think you all put up a very good point that it's like a catalyst. So I know consumer and companies work hand in hand to actually move it forward, right? And of course, it's China. They move really fast, right? So let's move on to the next question, right? So from the institutional side of the business, can you actually share with us, how professional traders, family offices, and wealth managers, at least in Asia, actually using these ETFs in their portfolio?
I think that's a very good question. I mean, looking like earlier slides in the earlier sharing is that we have a wide range of clients using our ETF, and so what we do is we have family offices and we have private banks doing structures on our ETF because of the liquidity and the tight and beta spread. And having said that, one is actually family offices will definitely want to do a thematic exposure using their cash and have a thematic exposure into Hang Seng tech itself, be a part of the thematic portfolio, short-term portfolio. We also seen private banks, doing structured by doing fixed coupon notes, exchange link notes, and accumulators. So we could see that due to the advantage of a very tight spread, and we could see that more and more institutions such as private banks and family offices are using our ETF for many different products. And so we were saying that this has actually on-screen liquidity is very important, and that's actually help us as a firm to actually have a wider and more diversified clients using our ETFs.
Thanks for sharing, Adrian.
Yes.
I think it's always interesting to actually look from the institutional side of things, where they have a lot of money under big AUM as well. Yep. All right. So I think we're a little bit short on time. I think let's move on to the question and answer section. All right. Let me pull out some of the questions. Stop sharing screen. All right. Okay. I think this question is probably for Adrian, right?
Yeah.
So there's a person actually asking this question. Can you help me to understand how much I'm paying for the ETF?
Yep.
Is it 0.99% TR plus 0.99% management fee? So essentially it's 1.98% in total.
Okay.
Could you shed some light on that?
Yes, Ethan. That's actually a very good question. No, the total expense ratios includes everything required for the fund manager to pay to operate the fund. Total TER includes management fees. Now, our management fees of 0.99, we need to be upfront and tell you that 0.99 includes our normal management fees for our managers. We also add in our fees for custodies, administrative fees, and some of the other fees, miscellaneous, small part of miscellaneous fees to run the fund. So our management fees not just talk about paying about our just purely our management fees. We also put in fees required to run the funds, and that's why 0.99 seems a bit high to most of our competitors. But we include everything, management fees as all asset manager would publish. We also put in other fees like custodian fees, administrative fees, and miscellaneous fees into the management fees itself. So total expense ratio of 0.99, it's everything, inclusive of everything, like transactional costs that needs to deploy to buy the underlying stocks as well. So to answer simply in summary, total TER is included the management fees. So if you want to see what you really pay in total, it's total TER. If you want the breakdown of the total TER, management fees is part of it. So same. So to answer the question, 0.99 is what you pay when you invest into CSOP's ETFs. So it's not 1.98. Yeah, you don't add them. Yes.
Thank you, Adrian. I think that clarifies that for you. All right. Yeah. So let's move on to the next question. So I think this one it's open to the floor, right? So anonymous attendee actually asked, right? If I were to hold a long-term China/HK related ETF, say next 5 to 10 years, so which top 5 ETFs would you prefer to look at?
Wow. Maybe Benjamin, you could probably start the ball rolling.
I don't want to be. The CSOP Tech ETF is one. I mean, that I like to also forecast because we are actually talking about the outperformance of the Nasdaq, and that is something that I like to highlight. 3033. So I'll put it out there.
Okay.
So the Adrian doesn't have to talk about that.
Sure. No, I think it's hard for us, any one of us, to tell you what are the 5, what are the long-term ETF to track, because Benjamin is pretty much younger than me. So there are different. Each investors entering a different phase in life.
Different appetite too.
Different appetite, different risks that you are willing to take, different objective that you hope to achieve. 5 to 10 years. I think maybe for me, I were to invest so that I could actually set aside for retirement, set aside for my kids' education. So it's really dependent on where you are in the stage of life right now. Maybe just to share, my portfolio is actually I would do a balance. I'll do a core satellite kind of structure. So core will probably be built up with ETF that is of the old economy, of more value stocks. So I'll probably go into like a China A50, which provides a bit of dividend and exposure to the financials, because we believe that right now with the vaccine introduced, the higher possibility of life returning back to normal, and that that will spur up the old economy again. It starts businesses will recover, and then loans will be going back to will be applied to the finance. So China A50 is something that I will put into my portfolios in terms of core product capabilities. There's definitely we want to set aside some for like Benjamin, I say, for my kids who is actually much younger. They're able to expose themselves to volatility a longer term, yet a wider growth. So again, there is no straight answer to that question, but it depends on what you're looking for as an investor. Yeah,
I think I would like to add on Adrian's point as well. So a a lot of investors have different risk appetite as well. And there are different products for different investors, right? So I think let's put some of the ETFs that Adrian has mentioned into the chat box. All right. So the ticker codes are inside the chat box. Hope everybody can see it, right? So of course, if you're looking at the ShineX ETF, the code is 314. Of course, listed in the Hong Kong Stock Exchange. And if you're looking at the Hang Seng Tech Index ETF, it's 3033. Right? For the leverage 2x, it's 7226. And for the inverse 2x, 7552. All right. So you can actually look at those who are interested, please look at the chat box. All right. So let's move on to the next question, right? So okay, there's another person asking, is there a CSOP tech ETF on A-share?
Unfortunately, right now we do not have. No, we do not have that. Yeah, there is other products already there, and we wouldn't want to put a tech ETF onto US again, and then with the US administration clamping down and delisting the tech companies, and then I as ETF managers also would run into a risk of being asked to delist as well. So I think for Chinese tech, it's best to put it within Asia, and it's closer to the investors here and the clientele of the Chinese tech company. Yeah. So right now we do not have it yet.
All right. So let's move on to the last question because we're a little bit short on time.
Yes.
Right. I think it's for Adrian as well. This question: do you have an ETF tracking the SSE Science and Technology Innovation Board 50 Index? Wow.
Wow.
Right.
Yes.
You guys have that?
We would love to do that as well. I think the SSE Science, or we call it for short STAR, it's actually a competitive product for Chinex Index, and also another similar product for the Hang Seng Tech Index as well. So right now we already have two Chinex already, which is listed on Shenzhen, and we also have already the Hang Seng Tech itself already. So I think that for a firm itself, it doesn't really make sense for us to do the STAR ETF as well, because we're already managing two tech-related index ETF. Yeah.
All right. Thank you.
Yep.
So guys, don't leave yet. There's something else that we'd like to share with you as well. All right. You guys can see my screen, right?
Yes.
So, right now, of course, this webinar is in partnership with CGS-CIMB and CSOP, right? So there's actually an exclusive promotion for you guys, right? So there's up to $5,000 worth of NTUC fair price vouchers, of course, when you buy the selected ETFs with CGS-CIMB account. All right. Of course, terms and conditions apply. Do click the link down here as well if you like, right? So check it out. All right. Okay. Another thing is, if you're not a CGS-CIMB client yet, they're actually having a 50% commission rebate, right? Of course, there's a cap at $200, but if you're interested, please go on to the link www.cgs-cimb.com.sg/en/open an account. All right. So of course, for us today, exclusively for the audience, you can indicate the referral code. So the referral code is INV December 20. All right, DEC 20. Everything it's there. All right. You guys can take advantage of this and just check it out. All right. So with that, I think we have come to the end of our webinar. I would like to thank everybody, especially the audiences, for tuning in tonight. Special thanks to Adrian and Benjamin for the insightful sharing. And if you have any trading account related inquiries, please email to this email, colin.ng@cgscimb.com. So with that, we will call it a night, and we'll see you guys at the next upcoming webinar. All right. Thank you, everybody.
Thank you all. Bye.
All right. Bye-bye.
Bye.